Hello friends, welcome to today's session on GST. I am CA Renu Srikanth Tantry here. In my previous video on GST, I gave you a brief introduction on GST. Now, in today's session, we will learn about GST in little more detail. As I had explained to you in the previous video that GST is an indirect tax. Therefore, one of the features of GST is that it's a comprehensive indirect tax. What do we mean by comprehensive indirect tax? Means it is one tax which is covering up all the different taxes which were there before. Basically, GST has replaced the old indirect tax regime. In the old indirect tax regime, there were several different taxes under the indirect taxes. Like there were several taxes, central taxes, which were levied by the central government, like the central excise duty, service tax, special additional duty of customs called as SAD, etc. There were many more. Similarly, state taxes were levied like in the form of state VAT, value-added tax, central sales tax, luxury tax, entry tax, so on. So all these indirect taxes have been replaced with one indirect tax, a comprehensive indirect tax, which we call as GST, Goods and Services Tax. So it's a tax on goods as well as on the services. The motto was one nation, one tax. Entire state there will be only one tax, one indirect tax now, that is Goods and Services Tax. Now further, when we talk about GST, if you see in your bill, sometimes you find that there is two items added as GST. One you call it as CGST so much percentage, SGST so much percentage. Sometimes you find there is only one, like IGST. Now what is that all about? We said only one tax, GST. Now why is there that splitting? Basically, that depends upon what type of supply. You know that GST is a supply-based tax, which I'll be discussing in the next slide. So basically, when there is a supply, GST would be levied on that supply, whether it's on goods or on services or a combination of goods and service. So now this supply can take place between people who are living within a state, or it might be taking place between a person living in one state and the purchaser being in another state. So that makes the difference. Now, therefore, when it is an intra-state supply, which means when it is within a state, like for example, if the supplier that we are talking about who is selling the goods is in Bangalore, which is in the state of Karnataka, and the customer who is purchasing from him is say in Mysore, which is also in Karnataka. So both of these are in the state of Karnataka. Then that is called as intra-state supply. The supplying is going within the state of Karnataka. And at this point of time, you will find that in the bill, when GST is levied, it will be levied as CGST and SGST. Now, what does CGST stand for? CGST stands for Central Goods and Service Tax, and SGST stands for State Goods and Service Tax. Now, as I told you in the previous regime, the center levied certain taxes, state levied certain taxes, and you know that both center and state have their own commitments, and that is why they collect taxes so that they can spend on those commitments. Now, therefore, here when one GST is being charged, now both center and state require revenue. So that is why when GST is being collected, it is being collected and it is being split like this between the center and the state. So the CGST, that is Central Goods and Service Tax, is which the center would get, whereas whatever is being put into the state SGST, that would be received by the state. So that is how the split. Therefore, suppose the goods that we are talking about on which GST is being levied is supposed at the rate of 12%. Then that is being split, and it will be split as 6% would go as CGST, 6% would go as SGST. So if it is 18%, 9%, 9%. It is split between those two half-half. Now, the other case is the interstate sale. That is, in between two different states. So here we take that the supplier is, say, we'll take the same supplier who is in Bangalore, but if he is supplying to a customer, say, in Mumbai. So you know Bangalore is in the state of Karnataka and Mumbai is in the state of Maharashtra. So this is a case where the supply is between two different states, and therefore that is called as interstate supply. And when there is such an interstate supply, the GST that is levied is called as IGST. IGST stands for Integrated Goods and Service Tax. So in all interstate supply, what is charged? IGST. And suppose, as we said, if the rate of GST on that particular good is 12%, then IGST is charged at the rate of 12%. There is no splitting here, one single. And this would entirely go to the central government, which will thereafter allocate between the two different states their respective GSTs. So if it was 18%, entire 18% is collected under IGST. So this is how you would find that in different cases, you would find sometimes CGST, SGST, sometimes IGST. I hope that is clear. Now moving further. Further, when we talk about GST, when a person makes a purchase of goods or avails some services on which GST is being applied, then whatever GST that is being paid, that is called as input GST. So this would be from the accounting point of view. When we are going to learn the personal journal entry, then you know that when on, say, purchase of goods you are paying GST, then you would be debiting the purchases with the purchases value, and you would be debiting input CGST, input SGST, or if it is IGST, you would be debiting input IGST account debit. So that is the account input CGST or SGST IGST, that is whatever is paid on supply of goods and or service. So it can be on goods or on service or a combination of goods and service together. And the GST which is collected on supply, that is when it is being sold, goods is being sold, a service being rendered and money is being collected. At that time GST is also collected. Whatever is being collected, that goes into an account called as output GST. That's output CGST, output SGST, output IGST are the accounts that would be open. So these are the different concepts and item head, account head you need to know. Now, having understood all this, let us understand that who collects this GST. Now, this GST is collected by the registered taxpayer on behalf of the government, and then he pays it to the government. So now, who can register under GST is the first question. So any supplier who is carrying on any business at any place in India and whose aggregate turnover exceeds a threshold limit as may be prescribed, that particular supplier has to register under the goods and services tax. So now basically here the thing is, the main point is that the aggregate turnover should exceed the threshold limit. Previously it was around 20 lakh, but now it is around 40 lakhs. So when the turnover exceeds at 40 lakhs, at that point of time, the particular supplier will have to compulsorily register under GST and start collecting GST on the supply that he makes. Now you would say, what would be the benefits of registering under GST? First thing is that here when he is registered GST, he is legally recognized as a supplier of goods and services because he has a GST number. Second benefit that you can say is that he can utilize the credit of the input taxes he has paid. That is, whenever he made a purchase or he paid an expense and he had to pay along with that GST, which just now we saw as input GST, that he can claim against whatever GST he has collected from the customer when he made a supply, when he made a sale, or when he rendered some service, he collected GST. Against that, he can take a credit of whatever taxes he has paid, and only the net amount he can remit to the government. So that is possible only when the taxpayer is a registered taxpayer. So these are some of the benefits of being a registered taxpayer. Now the question comes, is registration compulsory? Registration is compulsory, but under certain circumstances. There are several circumstances. I've discussed only 4 of them here. Like, as we said, once the aggregate turnover exceeds the threshold limits which has been prescribed under the Act, it is compulsory that the supplier should register. Second is all those persons who are making interstate supply. That is, person living in Karnataka selling to a person in Mumbai, person living in Mumbai selling to a person in Rajasthan. That is interstate supply. Those people have to compulsory register. Their threshold limit will not be considered. Every electronic commerce operator means those who are selling online basically. If you're selling online even for value of 1 rupee, you have to register under GST. And further, all those persons who are notified either by the central government or state government on the recommendation of the GST councils, all those people are also covered and they have to register compulsorily. So these are people, some of the people who have to register compulsorily. Now moving further, we have also heard the GST, we call it a supply-based tax. What do we mean by that? Now basically we know that GST is levied on supply of goods or services. So here supply is the taxable event. So when there is a supply of goods or of services or a combination of this, then GST is levied. So tax gets levied when there is a supply. So that is why we call it as supply-based tax. So to understand it, suppose we'll take this case where there is a manufacturer who manufactures the goods. Probably the GST percentage on that particular product is 18%. So when he supplies that goods to the wholesaler, so he is making a sale here, there is a supply taking place. At that time, he will charge 18% GST. The wholesaler will pay the GST to manufacturer and manufacturer collects that GST. Similarly, when this wholesaler sells it to the retailer, again, he would be collecting from the retailer on the value of the goods that he is supplying. Retailer will pay it, wholesaler is collecting. And then when the retailer sells it to the customer, again he would charge 18% on that particular good that he has sold to the customer, and the customer is paying the GST here to the retailer. So this is how at every point of supply you find that GST is being levied on that product, on the taxable value of the product. Now one more important point I would like to cover up here is that when there is suppose a purchase of those goods, that purchase value is written. In case of any discount is there, like trade discount which is allowed on huge purchase or because of the high value, that has to be always deducted and the net value would be the taxable value. And always the GST, whatever is a GST or SGST or IGST, as the case may be, is levied on this taxable value. And this would be the total value of the transaction or the invoice value of the transaction. So this is one important point. So always you have to remember to deduct the trade discount and then on that net value GST is calculated. Now, one doubt might arise in your mind that at every stage we're saying the same product which is being sold, 18% is collected. So you might be thinking, now is this not double but triple taxation that is taking place? That here once 18, then again 18 and then again 18. 3 times 18% is being charged. No, the cascading effect is not going to be there. That is eliminated in GST by means of allowing set-off of the GST paid against the GST collected. So here what happens when the wholesaler sells to the retailer, he will be collecting from the retailer, but he will not pay the entire amount collected to the government, but he will take a credit of the 18% that he paid to the manufacturer. So from the amount collected from the retailer, he will be subtracting the amount that he paid, wholesaler paid to the manufacturer, and the net amount only would go to the government. So that now let us discuss That is why we call GST is value added tax. The tax is on the value addition that has taken place, not on the entire value. So this is how it would eliminate the cascading effect which you thought was there when we saw the previous slide. So to understand that, I've given a simple example here. Like, suppose there are 3 people involved in the transaction. First one, A. He is selling, say, 100 units of an item and the value of per item is 100. So 100 into 100, the value of that goods is 10,000. So right at this point of time, the value addition is 10,000 rupees. So now when GST, suppose the GST percentage is 18%, then 18% on 10,000 would be 1,800 is GST. And he is the first person making supply, so he has not paid any GST probably, we'll take it as nil. So the GST amount that he has to pay is entire 1,800 that he collects when he makes a sale to B. Now B is now going to sell those goods to C. So what happens here? He is selling the same 100 units but at 125. He will not sell it just at the cost. He will be adding the taxes, everything together, then he'll be adding his profit margin. So I'm taking it as say 125. So he is selling the same 100 units at 12,500. So what is the value addition? From 10,000, the value of the goods addition is 2,500. Now, bill amount being 12,500, the GST would be charged on this bill amount of 12,500 at the rate of 18%. So at the rate of 18% it comes to 2,250. But he's going to collect from C 2,250, but he has already paid 1,800 to A when he purchased. So that GST he can use to set off. So he's collected from C 2,250, but is paid to A 1,800. The net amount he's going to pay is 450 to the government. Now this B is selling to C. Now the C is going to sell ultimately to ultimate consumer at 150. So the value of that bill is 15,000. So what is the value addition here if you see? It is 15,000 minus 12,500, 2,500 is a value addition. So the GST will be charged at 18% on the bill amount of 15,000. So 18% of 15,000 comes to 2,700. This he is going to collect from the ultimate consumer. But on his purchase from B, C has paid how much? 2,250. So that he can claim as set off. So against 2,700 he has collected from his customer, he is going to set off 2,250 that is paid to B. So ultimately he will have to pay just 450. So if you total the GST amount that is going to the government, it is 1,800 plus 450 plus 450, 2,700 is reaching as GST to the government on these 100 units, which is chargeable to GST at the rate of 18%. So if you see, the ultimate consumer is getting at what value? 15,000 worth. On that, if you calculate 18%, it's 2,700. So don't you see how the cascading effect is being removed because of the set off of the GST which is paid, which can be claimed against the GST which is collected. So that is how here in GST on the value added only the tax is being levied. The cascading effect is removed by means of allowing set off of the input GST which is paid against the output GST. So I hope it is clear now. So hope you found this video useful. If you found it useful, please do like, share and subscribe to my channel. And please don't forget to click on the bell icon to get continued notification of my upcoming videos. We will continue to discuss more about GST in my next few videos. Thank you.